Show me the money. This is the Moneyweb Be a Better Investor podcast, picking the brains of professional investors on their investment strategies, successes, and mistakes. Your host, Ryk van Niekerk.
Welcome to this week's edition of the Be a Better Investor podcast. My name is Ryk van Niekerk, and in this podcast series, I speak to finance and investment professionals about their investment journeys and their approach to investments. We delve into their past and discuss how their perspectives on investments have changed over the years. And the idea is to find a few tips and tricks from their personal experiences to assist amateur retail investors to become better investors. My guest today is Charl de Villiers. He's head of equities at Ashburton Investments, and he has an interesting background. He first studied engineering, then moved into the financial world. He received an MBA from the University of Cape Town, and he is also a CFA. He started his investment career in 2003 when he was a management consultant at Nebula. 2 years later, he moved to Ireland as an equity analyst, and in 2008, he joined Sanlam as a portfolio manager, and he joined Ashburton in 2021 as the head of equities. Charl, thank you so much for your time today. First of all, give us a bit of background. Where did you grow up, and when were you first exposed to the investment world?
Thanks, Ryk. I've gone a roundabout journey, I would say, as you've alluded to, maybe not gone through the usual channels in doing accountancy and ending up in a financial institution from the get-go. I grew up, I was born and raised in Port Elizabeth in the Eastern Cape, so still really, although I've been living in Cape Town for many decades now, I still kind of consider myself as an Eastern Caper, should I say. Leaving school, one doesn't really know what you want to do with your life, and I think having two parents that had very little understanding of financial markets, I didn't know what I didn't know really. So I didn't even really know much or anything at all about financial markets and what the potential career opportunities were in financial markets, and kind of ended up doing one of these aptitude tests. And I thought at the time that I didn't want to end up working in office and wanted something that was kind of stimulating and kind of rewarding from a remuneration point of view. And so kind of, aptitude test pointed me in the direction of engineering, and I kind of off I went. And I suppose it finished up with, got my qualification and ended up, working in engineering for a few years. And, at that time, it was quite popular for a bunch of young people to, post-studies to end up in London on a working visa. And I went that route to get a bit of real-world experience and a bit of life experience, etc., and ended up working in engineering in London. And during that period, I think I kind of realized that that wasn't really filling my bucket, so to say, and started looking at what else I could do to maybe change career path. So at that point in time, still had really no view of financial markets or no understanding of financial markets and asset management per se, and ended up enrolling to do my MBA back at the Graduate School of Business in Cape Town, and ended up initially planning to do it on a part-time basis because I had to pay for it myself and was working in London, so I was saving up for that. And I think if you can cast your mind back, the rand really fell out of bed, I think, as I was about to move back from London to South Africa. And that allowed me to look at actually doing my MBA full-time instead of part-time. Otherwise, I would have had to work to supplement it. So I kind of brought all the money back into rand and managed to do my MBA on a full-time basis. And it was during that year that you obviously start to, first time I'd been experienced to the time value of money. I didn't know what that was prior to enrolling in my MBA. And during that course, I actually realized that, during those modules of the MBA, that was an area that I really, one, enjoyed, and two, had a competence in, I suppose. And then, one gets the opportunity within the MBA to kind of decide where you want to focus your energy in terms of electives and that. And then I, at that point in time was decided to push all my electives as much as possible into kind of financially orientated areas, financial markets, etc. So that's kind of a roundabout route really to how I got to where I am at the moment.
But that was, as you've said, a roundabout route. But, doing an MBA and focusing on the analysis of investment opportunities, you make or should have battled without an accounting background, I would assume. Just take us through how you adapted to be able to really become proficient in investment analyses without accounting.
Yeah, so I think it is obviously there's an element of accounting that one does in business school. It's one of the core subjects that you do, so you understand the basics. And post completing that one obviously does a lot of reading and your own research around it. I don't think understanding accounts is rocket science for any listeners out there. I mean, there is an element of common sense to it. Obviously, there's a lot of detail that what you do when you do your formal accountancy degrees, etc. That one as a person that hasn't done that won't get that nuance. But the skills one needs, in my opinion, to analyze a company's income statement, balance sheet, and cash flow, and understand more importantly around the business model, the risks, etc. I think there's a level of base understanding that one can get. And then obviously I also did my CFA shortly after completing my MBA. Once I realized that this was an area that I wanted to spend the rest of my working career in, and so that also gave me another step up in terms of understanding the accountancy side of things and other elements that maybe I hadn't covered previously in my MBA.
Now, the CFA qualification, I think that's the premier investment qualification you can get, and you learn a significant amount about the analysis of equities especially. When did you make your very first investment, an investment with money you've actually made yourself?
It would probably be significantly later than most people would assume. So, as I've mentioned to you, ended up finishing my MBA and by chance actually met Walter Eilert's nephew, brother-in-law, should I say, who was actually a school friend of mine on the trip back from somebody's birthday. I can't remember exactly what it was. And he was mentioning to me that his brother-in-law had just left Coronation and was opening up an asset management and was looking for people to join him in terms of growing that business. And that was a bit of fate or luck or whatever you want to call it. But being what I'd just gone through in terms of my MBA, that I knew that was the area I wanted to end up working in. And so I got into working with Walter, and that was after a brief stint doing some consulting engineering, as you mentioned. That was my work with Walter was my first real experience into the financial world. And at that point in time, we actually invested. Well, first we didn't have a lot of money to do investments, and the staff there obviously invest via the unit trust. So I only really got into making your own investments in terms of shares late in life. I think that was one of in looking back and understanding the value of compounding as one of my my greatest regrets, really, is that not being exposed to starting earlier really in my investment career. I think there's a huge missed opportunity for myself there, knowing what I know now. And I've got some teenage boys, and they really tease me. I'm always harping on about compounding and how it's the eighth wonder of the world. And I've already got them, their own share trading accounts, and they're already investing, and they've done pretty well already.
So when did you start? When did you realize compounding is excellent, but we haven't started early enough?
Yeah, so I didn't start that early. So I only started kind of during my tenure at Sanlam, really, if you can believe it. So, fortunately, subsequent to that, I think investment decisions have gone well. I think hopefully I can say I've got some competence in doing it well. So I've probably been able to catch up some of the lost opportunity that starting earlier would have brought me. But I still, as I mentioned to you, I think that's one of the biggest regrets really about not having started earlier. And it's more a function of just not knowing what I didn't know. And when I did know what value of compounding, didn't really have any money I was paying for my MBA and the like. So, but as soon as I, was in the industry and had funds available, that was kind of when I started really.
Were those investments contributions to a pension fund, or was it discretionary investments in addition to contributions to a pension fund?
Yeah, both discretionary and obviously usual contributions. You had very little control over, but then obviously we have the ability to invest on a discretionary basis as well. So a bit of both really.
But let's talk about the discretionary portfolio. What was the very first investment you've made?
Sure. Now you're asking me. Looking back, I think if I just think back, it was probably a company, I'm not sure if you'll even remember, that used to be on the JSE, Delta EMD, that used to have material that goes into alkaline batteries. For a long period of time, I was analyst at Walter, at Ashburton Company, as well as at Sanlam. It was still listed. It's obviously delisted many years back. And another company that springs to mind was UCS, which was an IT company that I was also analysing many moons back. Those are two that kind of spring to mind.
And did you make money from those?
Yes, I did. Both did very well out of them. So I haven't had too many disasters from a discretionary investment portfolio point of view, which is hopefully a good thing.
Yeah, I'm going to ask you about the disasters in a minute. But let's get to it. What has been the biggest mistake or dog of an investment you've made?
Oh, well, I suppose in professional capacity, we were investors in Steinhoff at a point in time, and that's my career at Sanlam, we were really material holders of Steinhoff at a point in time. Fortunately for us, we had reduced our exposure significantly when they started off on their M&A drive on the back of increased risk, etc. So by the time the pawpaw hit the fan, we were significantly smaller investors in the company than we were initially. But be that as it may, it was still something that you scars on your back and that you carry with you for the rest of your career. And those are good things. You learn from mistakes, and as long as you don't make the same mistake twice, I think that's mistakes are not the end of the world for listeners out there. I think we expect our team, myself included, that we have made mistakes. We will make more mistakes in future, but I think our objective is not to make the same mistake twice, and we move forward really. So it's part and parcel of why I find the investment career so appealing. You're not getting everything right on a day-to-day basis. You're going to be making mistakes. You're learning about new industries. You're dealing with really great caliber of people and intellect, etc. And it's a challenge on a day-to-day basis. Just when you think you're top of the world, something you think can come from left field and really take the legs out from under you. So you need to continue to have a huge amount of humility in this profession, really, because if you don't, you're asking for trouble, in my opinion.
Yeah, and obviously that also ties in with a diversified portfolio. So if there is a bad performing investment, the whole portfolio is not affected as much. But in many cases, amateur retail investors listen to a company's CEO or senior analysts in the industry when they talk about certain companies. And the CEOs can sometimes be very, very persuasive. And they talk a good game, but when the results are published, it is not as attractive. How valuable do you find the comments CEOs or senior directors of a company make, and does that influence your investment decision? Because I would imagine in Steinhoff's case, Marcus Jooste spoke a good game, and, look what happened.
So I think you've got to obviously not rely on management teams and management communications as to being one of the foundations of your investment case. I mean, that's just management communications are merely there to provide, maybe some color to your underlying assumptions and not assumptions around the investment case and what you're building into your valuations, etc. So, I mean, as you say, invariably, management teams are overly optimistic and are going to be obviously looking at the world through rose-colored glasses. So I think what's more important for, investors out there, both private investors and professional investors, is to do your own homework, to go in and read the annual reports from cover to cover, build your own model, understand that most importantly, understand the business model. What are the drivers of the business model? Which of those drivers are under control of management and versus out of control of management? And understand on the return on capital profile of the business and the volatility of earnings within the business over many cycles. And only after you've gone through that process, then if you're talking to management, etc., you overlay, those comments with your understanding of the business. And often you find that those don't tie up. And in those cases, over time, you learn to trust certain management teams more than others. And you learn to also take a lot of what management say with a pinch of salt and actually rely on your own fundamental research. The same goes for also relying on sell-side analysts' recommendations, etc., which are often driven by much more short-term thinking than as opposed to long-term thinking, which we investment teams try to focus our energy on. So,
that's an interesting view. You have professional investors, fund managers. They do the very, very detailed analyses. They've built their models. And then you will see in the portfolios that there are very divergent views. Some asset managers would own a particular share, while other asset manager would hold a competitor's share. So these analyses do not always match up. So maybe the question is it a science, investment analysis, or is there some art also to it?
No, there's most definitely a part art, part science. I mean, as anybody that's built a financial model will know, that there's a whole host of inputs that go into a financial model, be it discount rates, be it growth rates. There's obviously whole capex around working capital assumptions, etc. All these elements that affect your future free cash flow that a business can generate. And, it's usually dependent on what your inputs are. So, I mean, valuation is most definitely not a science. When our team, we get to a valuation point which we think is our kind of fair valuation, we by no means think that is a precise valuation. We understand very well there's a range of outcomes that could potentially play out over the future, and because of that, we rather like to think of it as, as a bear case to a bull case, and kind of the one point that we use as our valuation is kind of a midpoint of that range, and that's kind of our best estimate of how things may play out. But we know very well that things could be a lot worse than that, and other side may also might be a lot better. Various investors will have different views of the future and of discount rates to use, etc. So they can come to very different answers.
One of the biggest challenges for retail investors is underperforming investments. Let's say you buy a share, you believe it will fly, but then it doesn't. It really performs poorly. How do you think such an investor should take out emotion in that decision, but still take a decision which is, let's cut our loss and invest in something else?
I think one has to take a mature view, and this comes through years of working in the industry and also working with the right people and the right teammates, etc., to understand that there are going to be points in time where share prices will decline after you buy them. I mean, I always say to my team, nobody rings a bell, at the trough of the share price, so invariably you're going to buy into shares and they're going to carry on going down. It doesn't mean your investment case is wrong and that you need to, change tack, but you need to be mature and have a mature outlook that, where you've got a bunch of assumptions that have got you to a point that you believe that this was a good investment case. And as time goes on, we know that when you're making, forecasts of the future, you're invariably going to be wrong. And where your forecasts are materially wrong and those are material drivers of a company's valuation or investment case, you need to have the maturity within the team as well as yourself to say, I've made a mistake and things have changed. And at that point in time, you should have no qualms about selling something, even if it's dropped 30% from the point you bought it. I mean, put your hand on your heart and say, I was wrong. Things have changed. Things not as I understood them. I'm not happy to sell, but I mean, you're selling because you rather deploy that capital in an investment opportunity that the probabilities are more skewed in your favor. The risk return is more in your favor versus something where things have changed.
Lastly, if you could go back in time and speak to yourself when you were 20 years old, what would you tell yourself about how they should approach investments?
I would go back and say start early as possible. I would love to tell your listeners that investments shouldn't be daunting, and they are not rocket science. Understanding a company, even building a simple discounted cash flow model with basic Excel skills is quite within the capability of, I would imagine, a significant portion of the population that has got the appetite and the willingness to actually apply their mind to it. So you don't just have to listen to investment professionals like myself and other people that are telling you to buy or sell shares. You can do a lot of your own work and understanding, albeit it might seem daunting, but once you get into it, there's a huge amount of resources available out there to learn about that. So start early. Don't be scared to do the hard work. Roll up your sleeves and reach out to people that can help you. I mean, I think most investment professionals and people within your circles, etc., will be willing to help where you come across people that show the willingness to learn, etc., and got appetite to increase their base of knowledge. I would love to have started earlier. I think we're very blessed. I consider myself very blessed to work in investment management. It's an area that one gets a huge amount of career satisfaction out of. Come to work every day. I enjoy what I'm doing. There's a Japanese term, I think it's igao, I think it's called, how one finds meaning in life, and I think it's doing what you have a passion for. And I think that I've been fortunate to end up in a vocation that I've got a huge amount of passion for. So I don't feel like coming to work every day is a burden on me. I'm really excited to come to work. So I think that's been fortunate to end up doing what I'm doing.
Yeah, that's a valuable life lesson. Do what you love to do, and then it's not work. And I think the outcomes are very, very positive, and the efforts you put in is a lot more valuable to the firm than if you just do a job. And if you're just doing a job, then try and pursue your passion. But Charl, thank you so much for your time today and for sharing your insights with us.
No, thank you. It's a pleasure, and I hope it can help some of your listeners out there and provide some context.
Yeah, I think the tips regarding it should not be daunting. Just do the hard work and you can make good investments, hopefully get more right than you get wrong. But I think that's a valuable insight. But thanks again for your time. That was Charl de Villiers. He's the head of equities at Ashburton Investments.
Show me the money. That was the Moneyweb Be a Better Investor podcast with Ryk van Niekerk. Thanks for listening. Catch up and listen to all the Moneyweb podcasts on moneyweb.co.za or the app. Moneyweb, your trusted source for business and investment insights.